Stock market wins, mastering supply and demand zones. Welcome back, traders. Today we're diving into a topic that could significantly elevate your trading strategies: supply and demand zones. These zones play a pivotal role in market dynamics and provide high confidence levels for trading decisions. Whether you're a day trader, swing trader, or long-term investor, understanding and leveraging these zones can transform your approach to the stock market. In this video, we'll dissect the concept, teach you how to identify these critical zones, and show you how to effectively implement them in your trades. Let's break it all down step by step. Supply and demand zones are fundamental concepts in technical analysis, representing areas where buyers or sellers dominate the market. A supply zone occurs when selling pressure overwhelms buying interest, pushing prices downward. On the flip side, a demand zone arises when buyers outnumber sellers, driving prices upward. These zones are not random. They are often areas where institutional traders, those who move the markets, have set up their positions. This institutional activity creates visible, recurring patterns that we, as experienced traders, can interpret to gain an advantage. By spotting these zones, we can pinpoint where price reversals are likely to occur, helping us enter and exit trades at optimal levels. This knowledge allows you to manage risk and capitalize on high-potential opportunities. Supply and demand zones are essential because they reveal critical price points where actions, such as reversals or breakouts, tend to happen. Unlike random price levels, these zones are based on real market interest. Instead of chasing trades or reacting emotionally to price movements, traders who use supply and demand zones rely on systematic analysis. The result? Better timing, reduced risk, and higher win rates. For experienced traders, aligning with these zones means trading with the market's natural rhythm rather than against it. With this understanding, let's move to the actionable part: how to spot them. The key to mastering supply zones lies in recognizing phases of the market where selling activity occurs consistently. Step 1. Look for areas of consolidation before a downtrend. Supply zones often form after periods of price stability, consolidation. For example, if price consolidates and then sharply moves downward, the consolidation area acts as a signal that sellers have exerted pressure. Step 2. Identify sharp price drops. Look for charts where the price makes a sharp drop from an area. Steep declines after consolidation suggest strong supply. Step 3. Confirm the zone. Ensure the zone in question aligns with other factors like high volume during the drop. Volume spikes validate that significant players were actively selling. Step 4. Use time frames strategically. Use higher time frames, for example daily or weekly, for long-term zones and lower time frames, for example 4-hour or 1-hour, for short-term scalps or day trading entries. Recognizing demand zones follows a reverse approach, with the focus being on areas of consistent buying activity. Step 1. Find consolidation before an uptrend. Demand zones often arise after periods of consolidation or sideways price movement. For example, if the price consolidates and then moves sharply upward, the consolidation area becomes a demand zone. Step 2. Watch for sharp upward moves. Similar to supply zones, steep price increases after consolidation suggest significant demand. Step 3. Validate the zone. Check for volume spikes during the price increase. A high volume during the upward move reinforces the strength of the demand zone. Step 4. Compare across time frames. Use multi-timeframe analysis to confirm the demand zone is relevant for your trading goals. A short-term demand zone on a lower time frame may hold less weight than one visible on higher time frames. Identifying supply and demand zones is only the first step. Validating them is equally critical. Here are key analytical factors to confirm the reliability of the zones you find. Time frames. The time frame you choose plays a significant role. Larger time frames, such as daily or weekly charts, tend to produce stronger and more reliable zones compared to 15-minute or 1-hour charts. Price action signals. Candlestick patterns like dojis, engulfing candles, or pin bars provide clues about market sentiment. A bearish engulfing pattern at a supply zone can verify selling pressure, while a bullish pin bar at a demand zone signals buying interest. Volume confirmations. Volume is a measure of market participation. Significant volume during sharp price movements validates the strength of a zone. Multiple confirmations. Combine supply and demand analysis with other tools like moving averages, Fibonacci retracement levels, or trend lines. This confluence increases the reliability of the identified zones. By integrating these factors into your analysis, you can reduce false signals and improve the accuracy of your trades. To connect theory with practice, let's explore how supply and demand zones play out in real market scenarios. Imagine a stock price consolidating around $150 before dropping sharply to $140. The consolidation near $150 is a supply zone because sellers overwhelmed buyers there. If the price retraces to $150, it's likely to reverse again due to renewed selling pressure at this level. Now consider a scenario where a stock consolidates near $120 and then rallies to $130. The $120 area becomes a demand zone, as strong buying sentiment created the upward momentum. If the price retraces to $120, buyers are likely to re-enter, sparking another rally. In some cases, prices break through a supply or demand zone, only to reverse later. Understanding these scenarios requires interpreting volume and price action patterns to avoid being caught on the wrong side of the trade. As powerful as supply and demand zones are, missteps can still occur. Here are some mistakes traders often make. Overtrading. Misinterpreting minor consolidation areas as significant zones can lead to unnecessary trades. Focus on clear, well-validated zones for higher success rates. Ignoring volume. Without volume confirmation, zones may lack true institutional demand or supply. Always validate with volume to ensure strength. Timeframe mismatches. Applying a supply-demand zone from a 5-minute chart to a multi-day trade can result in poor execution. Match the time frame to your trading duration. By being cautious of these pitfalls, you can refine your approach and trade with confidence. For those who already have experience with supply and demand zones, here are some advanced ways to maximize their potential. Combine with trend lines. Look for zones that align with trend lines to confirm the market's direction. This combination often creates higher probability trades. Use moving averages. Moving averages can act as another layer of confirmation. For instance, a demand zone aligning with the 200-day moving average tends to be highly reliable. Set strategic stop losses. Place stop losses just beyond the zone boundaries to protect against false breakouts without exposing yourself to excessive risk. Adjust for different trading styles. Swing trading. Focus on multi-day demand and supply zones visible on daily or 4-hour charts. Day trading. Use shorter time frames to identify intraday zones, but validate their strength on higher time frames. Long-term investing. Prioritize major zones on weekly or monthly charts, as they represent institutional interest over broader time horizons. When mastered, supply and demand zones grant several key advantages to traders. Improved entry and exit points. By entering at demand zones and exiting at supply zones, you secure trades at optimal points, enhancing profitability. Increased confidence in trade execution. Relying on well-defined zones reduces emotional decision-making and creates a disciplined approach. Consistency across markets. These principles apply not just to stocks, but to commodities, forex, or any market that relies on buyers and sellers. Understanding and leveraging these dynamics allows you to trade with the flow of the market, rather than being caught off guard by price movements. Supply and demand zones are foundational tools that every experienced trader should incorporate into their trading arsenal. By identifying these zones, validating them with price action and volume, and avoiding common pitfalls, you can enhance both the consistency and profitability of your trades. Remember, success in the stock market is not about predicting the future. It's about responding intelligently to the present. Practice what you've learned today, implement these strategies in your trades, and watch as your results improve over time. Thank you for joining us in this educational journey. If you found this video insightful, don't forget to like, subscribe, and share your thoughts in the comments below. Let's keep refining our strategies and growing together as traders.